Intro. Welcome back to the channel. Today we are going to talk about one of the most popular and accessible investment instruments available to ordinary investors in India, the mutual fund. You have probably seen the advertisements that say mutual fund sahi hai and wondered what exactly a mutual fund is and whether it really is the right investment for you. By the end of this video, you will have a complete and clear understanding of what mutual funds are, how they work, and why millions of Indians invest in them every month. Let us get started. Section 1. What is a mutual fund? A mutual fund is essentially a pool of money collected from many investors that is professionally managed by an expert called a fund manager. Here is how it works. Imagine 10,000 people, each investing 1000 rupees into a common pool. That pool now has 1 crore rupees. A professional fund manager then takes that 1 crore rupees and invests it across a carefully selected portfolio of stocks, bonds, or other securities on behalf of all these investors. Each investor owns units of the mutual fund, proportional to the amount they invested. As the value of the underlying portfolio rises or falls, the value of each unit rises or falls accordingly. The price of each unit is called the net asset value or NAV. Mutual funds allow ordinary investors who may not have the knowledge, time, or large amounts of capital to invest directly in stocks to still participate in the growth of financial markets through professional management. Section 2. Types of mutual funds. There are many types of mutual funds in India, but let us focus on the most important categories. The first category is equity mutual funds. These invest primarily in stocks. They are suitable for long-term investors who can tolerate short-term volatility in exchange for potentially higher returns over time. Within equity funds, there are further subcategories. Large cap funds invest in the biggest and most stable companies. Mid cap funds invest in medium sized companies with higher growth potential, and small cap funds invest in smaller companies with the highest growth potential but also the highest risk. The second category is debt mutual funds. These invest in fixed income instruments like government bonds, corporate bonds, and money market instruments. They are generally considered safer than equity funds and are suitable for conservative investors or those with shorter investment horizons. The third category is hybrid mutual funds. These invest in a mix of both equity and debt, giving you the growth potential of equity with some stability from debt. They are a good starting point for beginners who want a balanced approach. Section 3. SIP Systematic Investment Plan. One of the most powerful and popular ways to invest in mutual funds is through a SIP, which stands for Systematic Investment Plan. A SIP allows you to invest a fixed amount, as little as 500 rupees per month, into a mutual fund automatically on a fixed date every month. SIPs are powerful for several reasons. First, they instill financial discipline by making investing a regular habit. Second, they take advantage of rupee cost averaging. When markets are down, your fixed SIP amount buys more units. When markets are up, it buys fewer units. Over time, this averaging reduces the impact of market volatility on your overall investment. Third, SIPs harness the power of compounding. Even small amounts invested regularly over long periods can grow into significant wealth. A SIP of just 5,000 rupees per month for 20 years at a 12% annual return grows to approximately 50 lakhs. This is the magic of disciplined long-term investing through SIPs. Section 4. Advantages and things to keep in mind. Mutual funds have several important advantages for beginners. Professional management means you do not need to be a stock picking expert. A qualified fund manager does the research and makes the investment decisions for you. Diversification means your money is spread across many different stocks or bonds, reducing the risk of any single investment going wrong. Liquidity means you can redeem your mutual fund units on any business day and receive your money within a few days. Affordability means you can start investing with as little as 500 rupees per month, and SEBI regulation means all mutual funds in India are strictly regulated, providing investor protection. A few important things to keep in mind. Equity mutual funds are subject to market risk. Their value can go down in the short term. Always invest based on your risk tolerance and investment horizon. Check the expense ratio of the fund. This is the annual fee charged by the fund house for managing your money. Lower expense ratios mean more of your returns stay with you. And always look at a fund's long-term track record, at least 5 to 10 years before investing. Outro. To summarize, a mutual fund is a professionally managed pool of money collected from many investors and invested across a diversified portfolio of stocks, bonds, or other securities. The main types are equity funds, debt funds, and hybrid funds. SIPs are the most powerful and disciplined way to invest in mutual funds, starting with as little as 500 rupees per month. Mutual funds offer professional management, diversification, liquidity, and affordability, making them one of the best investment options for beginners in India. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.